You are leaving money on the table and you do not even know it. If you own a business in Canada and you are still paying yourself the same way you did 5 years ago, there is a very good chance you are missing opportunities to improve your long-term tax efficiencies. The rules have changed. The strategies have evolved, and what worked in 2019 may no longer be as efficient today. Today, I am going to show you exactly how to fix that. Hi, if you are new here, my name is Elizabeth, and I am the founder of Boss Budget Labs. I spend my days helping Canadian business owners stop giving the government more than they have to and start building real wealth with the money they actually earned. Today, I am walking you through 3 tax planning strategies that are often overlooked in traditional year-end conversations. The salary versus dividend debate, corporate structures that can legally improve tax flexibility, and the registered accounts most business owners completely ignore. If you find this helpful, do not forget to like, comment, and subscribe for more real-world money advice. Strategy 1. The salary versus dividend debate. The conventional wisdom has always been, take dividends because the tax rate is lower. Your accountant probably told you this, and on the surface, it makes sense. Dividends avoid CPP contributions and come out of after-tax corporate profits. But here is what many people do not realize. When you rely exclusively on dividends, you are building zero RRSP contribution room. Zero. And you are not contributing to CPP, which means no future CPP retirement benefits through that income either. Here is the long-term impact. A business owner earning $150,000 per year who pays themselves entirely in dividends for 20 years builds zero RRSP room, which can materially reduce long-term tax-deferred retirement savings opportunities. Had they taken a salary of around $90,000 instead, they would have built significant RRSP room every single year. That room compounds. It shelters investment growth and it creates flexibility when you actually want to retire. The optimal strategy for many Canadian business owners is a blended approach. Take enough salary to maximize your RRSP room. For 2026, that is 18% of your prior year earned income, up to $33,810. Then take the rest as dividends. This gives you the tax deferral benefits of dividends, RRSP room, CPP benefits, and long-term flexibility in how you withdraw from your corporation. If you have been dividends only for years and have no RRSP room, you are not alone. That is exactly the situation we help business owners untangle at Boss Budget Labs. Strategy 2, corporate structure. This is where things get really powerful and where most business owners tune out because it sounds complicated. Stay with me because this strategy could materially affect your long-term after-tax wealth. Here's the situation. Your corporation is earning more than you need to live on. That excess money sits in your company being taxed at the small business rate, generally 9 to 12% on the first $500,000 of active business income, depending on your province. Pull it out personally and you may pay 40% or more. That spread is your opportunity, and many business owners do not fully optimize it. Mistake number 1, they leave that money sitting in a basic business account, earning very little. Mistake number 2, and this one is worse, they invest it inside their operating company, which can create complications if you ever want to sell the business or access the lifetime capital gains exemptions. The smarter move for some business owners is a holding company. Your operating company pays dividends up to your holding company. Your holding company invests that money. When you eventually want to access it, you have options like pay yourself dividends over time, use capital for other investments, or potentially access the lifetime capital gains exemption, which for 2026 is approximately $1,250,000 of tax-free gains on qualified small business corporation shares, assuming all eligibility requirements are met. A holding company is not right for everyone, but if your corporation consistently earns $50,000 or more per year in excess profits, the long-term tax deferral benefits may well outweigh the additional costs. Strategy 3. Your registered accounts are a business planning tool. This is the one most business owners miss entirely. Your TFSA and RRSP are not just personal savings accounts. They can function as powerful tax planning tools when connected properly to your corporation. Here is how it works with your RRSP. You pay yourself a salary deductible for the business, which lowers your corporate tax bill. You contribute that salary to your RRSP, creating a personal tax deduction too. The money grows tax deferred, and when you withdraw in retirement, ideally, you are in a lower tax bracket. Your TFSA works differently, but is equally powerful. Contribute after-tax dollars inside the TFSA. Qualified growth and withdrawals are generally tax-free under current Canadian tax law. And here is what most people miss. TFSA withdrawals do not affect your OAS eligibility in retirement and do not count as income for GIS purposes. Most business owners max out neither account. They leave RRSP room unused because they took dividends. They ignore their TFSA. Meanwhile, their corporate investment portfolio generates passive income taxed at elevated rates. This creates long-term inefficiencies that add up significantly over time. Here is what this all comes down to. The Canadian tax system generally provides more flexibility for business owners who plan proactively. The business owners who build the most tax-efficient outcomes are not doing anything aggressive. They are simply planning ahead instead of reacting at tax time. Blend your salary and dividends properly. Use corporate structures when the numbers make sense. Max out your registered accounts before investing inside your corporation. And work with someone who actually plans, not just files. Every year you delay that kind of intentional planning is a year of compounding tax savings and sheltered growth you cannot get back. That is the real cost of waiting. If you are ready to take control of your finances and start building real wealth, book a free call with my team using the link in the description below. And if you want to keep learning and connect with others on the same journey, join my free school community. The link for that is in the description too. I hope this has helped you, and hopefully you will keep watching. See you next time.